I bought my first Bitcoin at $200, then I watched it crash 85%, I watched it crash 70%, I watched it crash 50% multiple times, and every single time I heard the same thing: Bitcoin is dead, it's going to zero, you're an idiot for holding, and every single time, the people who sold at the bottom regretted it for years. I'm going to show you exactly how I would invest $10,000 right now during this crash, using the same framework that's guided my investments for the past decade. But first, you need to understand something critical. The way you invest $10,000 matters more than when you invest it. Most people get this backwards. They obsess over timing. They try to catch the exact bottom. They wait and wait and wait for the perfect entry point. And they miss the entire move. Before we dive in, subscribe and hit the notification bell. What I'm about to share is the actual framework I recommend to everyone, from beginners with $500 to institutions with $500 million. This isn't theory. This is how wealth is actually built in volatile markets. Now drop a comment. How much of your portfolio is in crypto right now? Be honest. I want to see where everyone stands. The psychology problem. Let me tell you why most people fail at investing in crypto. It's not because they're stupid. It's not because they don't understand the technology. It's not even because they pick the wrong assets. They fail because they can't handle the volatility. Bitcoin regularly crashes 30% to 40% even in bull markets. We've had 20% plus corrections in this cycle alone. Quality altcoins can fall 50%, 60%, even 70% before recovering. That's not a bug. That's how this asset class works. And here's the problem. When you invest a lump sum, let's say your entire $10,000 at once, and then the market drops 40% the next month, you're sitting on a $6,000 position. Psychologically, that destroys people. They panic, they sell at the bottom. They swear off crypto forever. Then they watch it rally 300% over the next 18 months while they sit on the sidelines. I've seen this happen thousands of times. Brilliant people, smart people, people who intellectually understand the thesis, they still blow it because they couldn't handle watching their money temporarily go down. So the first question isn't, what should I buy? The first question is, how do I invest in a way that I can actually stick with? The dollar cost averaging framework. Here's the strategy I recommend to virtually everyone. It's called dollar cost averaging, or DCA, and it's the most powerful tool in an investor's arsenal for volatile assets. The concept is simple. Instead of investing your $10,000 all at once, you break it into smaller pieces and invest at regular intervals regardless of what the price is doing. Let me show you how this works with your $10,000. Option 1. The 10-month plan. Invest $1,000 per month for 10 months. Every month, on the same day, you buy $1,000 worth of crypto. Doesn't matter if Bitcoin is at $70,000 or $50,000 or $100,000, you buy. This spreads your risk across multiple entry points. Some months you'll buy high, some months you'll buy low. Over time, it averages out to a favorable entry price. Option 2. The 20-week plan. Invest $500 per week for 20 weeks. This gives you even more entry points and even more smoothing of volatility. In a choppy market like this one, weekly purchases can capture more of the dips. Option 3. The hybrid approach. This is what I actually recommend for most people. Invest 50% immediately. That's $5,000 to get exposure to the current discounted prices. Then DCA the remaining $5,000 over the next 10 to 20 weeks. Why the hybrid? Because if you're investing during a crash, prices are already significantly discounted. You want some exposure at these levels, but you also want dry powder in case it goes lower. This approach captures the discount while protecting you psychologically if the market continues to fall. The allocation framework. Now let's talk about what to actually buy with that $10,000. I've studied this for 35 years. I've run the numbers. I've seen what works and what doesn't across multiple cycles. Here's my framework. 80-90 in major assets, 10-20 in higher risk bets. That's it. That's the entire strategy. Let me break it down. The core position, 80-90, $8,000 to $9,000. This goes into the major layer 1 blockchains: Bitcoin, Ethereum, Solana, maybe Sui if you want additional exposure. Why these assets? Because they have real adoption, real users, real network effects. They're not going to zero. They might pull back 30%, 40%, 50% in a bear market, but they'll recover. They always have. Here's my suggested split for the core position. Bitcoin, $40-$54,000 to $5,000. Bitcoin is the pristine collateral of the crypto ecosystem. It's the store of value. It's the asset that institutions are buying. It's the least volatile of the majors. If you can only own one asset, own Bitcoin. Solana, $30-$43,000 to $4,000. Solana is the high-performance blockchain where most of the activity is happening. Faster transactions, Lower fees, better user experience, more developers building. I've had as much as 80% of my liquid crypto in Solana because I believe it will outperform Bitcoin in this cycle. Higher risk, higher reward. Ethereum, 10-20. $1,000 to $2,000. Ethereum is the backbone of DeFi and ENFs. It's slower and more expensive than Solana, but it has the deepest ecosystem. Some exposure makes sense for diversification. The speculation position 10-20, $1,000 to $2,000. This is what I call the Degen bag. This is the money you're willing to lose completely in exchange for asymmetric upside. Maybe it's a smaller layer one like Sui that could outperform. Maybe it's a DeFi protocol you believe in. Maybe it's a well-researched altcoin with genuine adoption. The key is, this money could go to zero. Price it in, accept it, don't put more than 10-20 here. And please avoid leverage. Avoid meme coins unless you truly understand your gambling. Avoid anything someone on Twitter is shilling without doing your own research. The minimum regret portfolio. Let me introduce a concept that's changed how I think about investing. I call it the minimum regret portfolio. Here's the idea. In 5 years, you're going to look back at the decisions you made today. You want to be able to say I made reasonable decisions based on the information I had. You don't want to look back and say I was an idiot. I put everything into some random altcoin because a YouTuber told me it was going to 1000x, the minimum. Regret portfolio is designed so that, if crypto moons, you participate in the upside. If crypto crashes, you don't lose everything. You can sleep at night regardless of what happens for $10,000. That looks like $5,000 in Bitcoin, 50% $3,000 in Solana, 30% $1,000 in Ethereum, 10% $1,000 in higher risk bets, 10%. This isn't the portfolio that will make you the most money if everything goes perfectly. This is the portfolio that will protect you from catastrophic mistakes while still giving you meaningful exposure to the upside. And in my experience, avoiding catastrophic mistakes is how you actually build wealth over time. The DCA execution plan. Let me give you a concrete example of how to execute this. You have $10,000. You want to use the hybrid approach. Here's exactly what you do. Week 1, deploy $5,000, 50% of capital, $2,500 into Bitcoin, $1,500 into Solana, $500 into Ethereum, $500 into your higher risk pick Sui, or research something yourself. Weeks 2-20. Deploy $250 per week every week. On the same day, invest $250. Split it according to your target allocation. $125 Bitcoin, $75 Solana. $25 Ethereum, $25 higher risk pick. After 20 weeks, you're fully deployed. You've captured whatever discounts occurred during the crash, and you never had to make a single timing decision. You just followed the system. Why this works? Let me explain the math behind why DCA is so powerful. When the price drops, your fixed dollar amount buys more coins. Let's say you invest $500 per week in Bitcoin. Week 1, Bitcoin at $80,000. Your $500 buys 0.00625 BTC. Week 2, Bitcoin drops to $70,000. Your $500 buys 0.00714 BTC. Week 3, Bitcoin drops to $60,000. Your $500 buys 0.00833 BTC. Week 4, Bitcoin recovers to $75,000. Your $500 buys 0.00667 BTC. Over those 4 weeks, you invested $2,000 and accumulated 0.028839 BTC, your average cost. About $70,450 per Bitcoin. If you had invested the full $2,000 in week 1 at $80,000, you'd have only 0.025 BTC. By decaying, you got 13% more Bitcoin for the same investment. Now extrapolate that over months, over years, over multiple cycles. The math compounds massively in your favor. The mental framework. Here's the most important part of this entire video. You need a mental model for how to handle the volatility. Let me give you mine. Expectation number 1. This will go down before it goes up. Even if we're in a bull market, expect 35% corrections. They happen constantly. If you're not mentally prepared for your $10,000 to temporarily become $6,500, you'll panic at exactly the wrong time. Price it in before you invest. Expectation number 2. The timeline is years, not months. Don't invest money you need in the next 12 months. This is a 3 to 5 year bet minimum. If you need the money for rent, for emergencies, for anything essential, don't put it in crypto. The people who build wealth in this space are the ones who can afford to wait. Expectation number 3. You will be tempted to sell at the bottom. Every cycle, the bottom feels like the end of the world. The narratives get bearish. The headlines scream crypto is dead. Your friends mock you. And that's precisely when you should be buying more, not selling. I've bought Bitcoin at $200. I've bought at $3,000. I've bought at $10,000. I've bought at $30,000. The price doesn't matter if you're building a position over time. Expectation number 4. You will be tempted to chase pumps. When Bitcoin rallies 50% in a month, you'll want to dump everything in at once. FOMO is real, but that's often when you should be more cautious, not less. Stick to the system, don't chase. The risk curve you must understand. Let me explain something critical about how different assets behave. There's a risk curve in crypto. The more speculative the asset, the more it moves both up and down. Here's roughly how it works. Bitcoin pulls back 30% in corrections, Ethereum pulls back 40%, Solana pulls back 50%, SUI and smaller layer 1 second pullback 60-65, small altcoins can pull back 80-90. Or go to zero. This is why your allocation matters so much. If you put 50% of your portfolio in Bitcoin, your maximum drawdown in a severe correction is maybe 15% from that position. If you put 50% in random small caps, you could lose 40-45 of your total portfolio or more. The core of my Don't FCAC This Up framework is not to make the most money, it's to avoid losing too much, then compound over the long term. It sounds boring, but that's how wealth is actually built. The long-term perspective. Let me zoom out and give you the big picture. Crypto is currently a $3.5 trillion asset class. My models suggest we could reach $100 trillion within the next 10 years. That means we're approximately 3% of the way there. 3%. The opportunity in front of us is staggering, and it's happening during a period of massive global liquidity expansion, currency debasement, and institutional adoption. Your $10,000 invested today using this framework could be worth $50,000 to $100,000 or more in the next 5 years if my thesis plays out, but only if you can hold through the volatility. Only if you don't panic sell at the bottom. Only if you stick to the system. That's why how you invest matters more than when you invest. The Don't FCAC This Up rules. Let me give you the rules I tell everyone. Rule number 1, never use leverage. I cannot stress this enough. Leverage is how you get liquidated. Leverage is how you lose everything. Crypto is already volatile enough. Adding leverage is financial suicide. Rule number 2, only invest money you can afford to lose. If losing this $10,000 would ruin your life, don't invest it, period. This should be money you genuinely don't need for the next 3 to 5 years. Rule number 3, focus on the majors. 80-90 in Bitcoin, Ethereum and Solana. These assets have real adoption, real network effects, and won't go to zero. Everything else is speculation. Rule number 4, have a long time horizon. The crypto cycle is now 5 years, not 4. Plan to hold until at least 2028 or 2030. Short-term noise is just noise. Rule number 5, DCA and chill. Set up automatic purchases. Stop checking the price every day. Stop watching the charts. The less you look, the better you'll perform. Rule number 6, do your own research. Don't borrow belief from me or anyone else. Understand what you own and why you own it. Conviction built on knowledge is the only kind that survives bear markets. The bottom line, let me bring this home. You have $10,000 to invest during a Bitcoin crash. Here's exactly what I would do. Split the capital, 50% deployed. Immediately, 50% DCAD over 20 weeks. Allocate 2 majors. 50% Bitcoin, 30% Solana, 10% Ethereum, 10% higher risk picks. Execute consistently, $250 per week on the same day regardless of price. Set and forget. Stop checking daily. Review quarterly at most. Hold for years. Minimum 3 to 5 year time horizon. Don't panic. Expect 35% corrections. They're normal. They're healthy. They're opportunities. This approach won't make you rich overnight. It won't give you stories about catching the exact bottom. It won't feel exciting, but it will work. It works because it removes emotion from the equation. It works because it captures discounts automatically. It works because it keeps you in the game long enough to benefit from the long-term trend, and the long-term trend is clear. Crypto is going from $3.5 trillion to $100 trillion. Liquidity is expanding. Currencies are being debased. Institutions are adopting. You just need to be positioned and patient. Final thoughts. I started investing in Bitcoin at $200. I've held through multiple 80% crashes. I've watched my portfolio swing by millions of dollars in single days. And you know what? I've never sold, not once. Because I understand the thesis, because I sized my position correctly, because I built conviction through research, not through following what other people told me. That's the game. Not timing the bottom perfectly, not picking the one altcoin that does 1000x, not leveraging yourself to the moon, just consistent investing in quality assets over long periods of time. That's how wealth is actually built. Your $10,000 isn't just money, it's a seed. Plant it correctly, nurture it patiently, and let time do the work. Don't FCAC this up. If this framework made sense to you, hit that like button right now. Subscribe if you haven't, turn on notifications, drop a comment and tell me, are you going to lump sum or DCA? What's your allocation going to look like? The crash is here. The opportunity is here. The question is, will you take it correctly? I'll see you in the next one.